Again, I'm Matt Conlin. I'm a sales and relationship manager for PFM Asset Management in the central part of Pennsylvania. And my colleague, Courtney Mulholland, will be presenting in about 15 minutes. And Courtney is a director, and she focuses on our clients in the eastern part of the state. And PFM Asset Management is the investment advisor and administrator to Pliget, the Pennsylvania Local Government Investment Trust. So that name might sound familiar to many of you. So just wanted to make that connection and maybe recognize our faces from different events over the years. So again, look forward to getting into it. All right. So today, Courtney and I are going to go over three main topics. I'm going to cover a current overview of economic conditions. Courtney will then cover the last two sections of Federal Reserve monetary policy and bond market dynamics. And if there are any questions, we'll be happy to answer those at the end. All right. So again, I'm going to look at current look at economic conditions. And as you probably are aware, news comes out all the time. Economic conditions have been changing rapidly. So these slides were finalized like 2 weeks ago. So I'll try to interject anything that's even more recent than what's on the slides. Okay. So I'm going to start here by looking at the job market and where we're at today and where we've kind of been over the last year or so. The job market has been one of the more stronger points of the economy and kind of more resilient in the last year or two, kind of since the pandemic was winding down. The first chart in the top left is a look at change in jobs by month over month. So if you look in April and May, you can see that jobs were reported as an increase of 165,000 and 272,000 respectively. Since this was finalized, those months were revised down to April is 108,000 and May is 218,000. So it's a pretty big decrease. And even the June numbers came in at the lowest in 3 years. So that's kind of showing that while the job market has been one of the stronger points over the years, it is starting to kind of get back down to normal or slow down a little bit. The unemployment rate has been at or below full employment since about 2022. The Fed has two mandates, and Courtney's going to talk about the Fed a little bit more, but you'll hear us reference that. The Fed has two main mandates, and one is full employment, and we've really been there for a while. So that hasn't really been one of their major concerns. Job openings, you can see, has reached the lowest levels since early 2021. There were a ton of job openings coming kind of out of the pandemic, and that's kind of come back down to normal. Continuing on the job market, you might recall during 2022, kind of coming out of the pandemic, there were 2 jobs available for every unemployed person looking for a job. So there were a lot of options out there. And with the large number of available jobs, that also leads employees to quit more often. And you can see the chart on the right shows the quits rate over the last 6 years. No one was quitting in the height of the pandemic. People were getting laid off, of course, furloughed, but no one was really quitting. But then as economy started opening back up, Fed was kind of opened up the economy by reducing rates. There were a lot of jobs available. So people were quitting, shifting around, finding new jobs. Both those numbers are returning to closer to average. There's just over 1.2 jobs available right now for every unemployed person, and the quits rate is below the pre-pandemic average. So now we're going to kind of tie in the job market to inflation. So inflation is the other mandate that the Fed has, or price stability is what they're looking for. And this is looking at the consumer price index, one index that is largely used to track inflation. As you can see, historically, you would want, and it's been that wage growth outpaces inflation, right? If you're an employee, you want to earn more than, or you want your wages to grow more than the price of goods is growing. That flip-flopped in coming out of the pandemic, as you probably all know, and have felt, in your bank accounts. Inflation ran rampant, and wage growth, while it was rising, wasn't rising as fast as the price of goods. That did flip-flop in 2023 and is correcting itself a bit. But as you can see, wage growth, while it is higher than inflation, it's still on a downtrend. So again, that's what we want to see: wage growth higher than inflation. So kind of on the right track there. But the Fed is still keeping a very close eye on inflation. So continuing to look at different ways that we look at inflation. Two different indexes here: the Consumer Price Index, again, that's the same one we looked at on the last slide, and the Personal Consumption Expenditures Index, which is the Federal Reserve's preferred gauge of looking at inflation. Both have been coming down as the Fed has hoped for over the last 2 years. CPI is at 3.3 and PCE is at 2.7. The Fed wants to see a basically 2% inflation rate, and that's their goal. That's kind of where they feel where price stability is at 2%. At the beginning of 2024, there was a lot of hope that we would get there and that we were well on our way to getting to a 2% inflation. And with every reading that came out throughout the year, overall we were heading that direction, but not as smoothly as the Fed had hoped. So they did not make any moves in their overnight lending rate. Again, Courtney will talk about that in more detail, but we're on our way. But there's still some moves to make. Now, the last CPI report for June did come in at its lowest since 2020. So that should give the Fed a little bit more confidence in making some movement in their main lending rate. And another look here at inflation. This is looking at core CPI and core PCE. Very similar to just regular CPI and PCE, but core CPI and core PCE remove food and energy from the equation. Food and energy are generally much more volatile. So this kind of looks at just the services sector of inflation, and numbers are very similar. It smooths out the lines a little bit, as you can see. But again, we're still on our way to 2%, but not quite there yet. All right. Oh, I see a polling question has come up. That might have come up a while ago, so make sure you answer that. Okay, existing home sales. This is not necessarily top of mind for the Fed, not one of their mandates, but still something that is important when looking and evaluating the economy. During the pandemic, rates were super low for 30-year mortgages as the Fed reduced rates, and as workers were able to go more remote in their jobs, they could move anywhere they wanted, basically. So a lot of workers were moving out of cities, more rural, and a lot of existing home sales were happening during the pandemic. Then, as the Fed raised rates and tried to make the economy a little bit more restrictive, 30-year mortgage rates went up, and those homeowners that either moved during the pandemic or refinanced during the pandemic to sub 3% mortgage rates now don't have as much incentive to move unless necessary for a job or for other reasons. So existing home sales have been on a decline and kind of below the pre-pandemic levels, while mortgage rates have been, are now at their highest in quite some time. All right. Consumer sentiment indexes. These two charts are looking at basically how consumers are feeling about the economy. So consumer sentiment index is one that we look at regularly, and it's just how consumers are feeling at that time about the economy and about the future of it. And their sentiment was high leading up to the pandemic, obviously dropped very sharply when the pandemic hit. But even during the pandemic, sentiment was going up. I mean, there was stimulus, rates were low. There was reason to feel okay about the economy. And then, as you can see, during 2021 to 2022, sentiment went down pretty sharply, generally due to inflation and how price of goods was rising very quickly. As the Fed made the economy more restrictive by raising rates and coming out of the pandemic, consumer sentiment was rising with some peaks and valleys, but rising overall. But as it dipped as of late, and that's kind of mostly due to the geopolitical environment and how the wars that are happening. If either of the wars expanded to anything larger than they are now, it could have major impacts on the economy globally and domestically. And consumers are still worried about inflation, even though it's coming down. It's still not where the Fed would like it. And prices are still rising. It's not like prices are going down. They're still going up, but just slower than they had been. The chart on the right takes a look at consumers' expectations for inflation over the next 12 months. Not really a whole lot to say here, other than it's interesting that consumers have, as of late, have felt that maybe rates will go up a little over the next 12 months instead of going down. And it's interesting because it's kind of a self-fulfilling prophecy. If a consumer expects prices to go up over the next 12 months, then they may be willing to pay a certain price today. And if companies know that consumers are willing to pay, then they might raise prices. So kind of self-fulfilling, but just an interesting look at consumers' expectations there. Real quick on this slide, interesting look at delinquent debt in the United States. The historic average is 5.8%, and you can see that during the Great Recession of 2008, 2009, delinquent debt was all-time highs, and has steadily come down ever since then. But it's been slightly on an uptick as of recently, largely just due to how far below the average we've been. I think it's just a little bit of a return to normal. During the pandemic, consumers didn't really have a whole lot to spend money on, so they weren't racking up a whole lot of debt, and there was a lot of government subsidies available. So as those run out and consumers kind of get back to normal spending, you can see that delinquent debt number going up just a bit. And one other thing on this slide, personal spending. The personal spending month-over-month numbers in April came in significantly lower than they were in February and March. So just more signs that the economy is slowing down a little bit finally after all this time. And then this is going to be my last slide before turning it over to Courtney, but a look at GDP. GDP was very strong in 2022 and even stronger in 2023. And the first reading of GDP in 2024 for the first quarter came back a little weaker at 1.3%. One of the biggest drivers of GDP is personal consumption, and that's the dark blue portion of the bar graph. And you can see that is significantly lower than the second half of 2023, and even first quarter of 2023 as well. So again, signs that it's going to be a slower economy this year, although interestingly enough, and I think Courtney has a slide on this later, the Fed does expect the economy to grow a little stronger than 1.3% during the course of 2024. So now I will turn it over to Courtney to go over her sections.
Thank you, Matt. Can everyone hear me okay?
Yes.
Yep. Great. So good morning, everyone. And thank you again for this opportunity. So our second section, we want to focus on the Federal Reserve and how the economic conditions that Matt just talked about have really impacted their monetary policy decisions. So if we move to the next slide and take a look at, where are Fed funds today. So as Matt mentioned, for the Fed to meet its dual mandate, which is ensuring price stability, so averaging a 2% inflation target, and full employment, the Fed really has three major tools in the toolbox. The first is the ability to set bank reserve requirements. The second is buying and selling securities to control liquidity in the market. And then the last one, and the most widely known, and what we're going to focus on today, is that short-term interest rate tool. So setting the target rate range for the federal funds rate. So that's what we show on this slide. The Fed had back in the onset of the pandemic, so in 2020, had implemented very aggressive expansionary monetary policy. So what does that mean? Well, you can see where rates really dropped off a cliff. At that time, the Fed wasn't really concerned with inflation. Rather, there was a lot of concern about just making sure the economy didn't fall apart. We all can remember those, challenging times. And obviously, as we all know, we had a big recovery and then did experience a period of very high inflation. So this caused the Fed to implement a restrictive monetary policy. So basically rapidly increasing the Fed funds target rate. So this is the step up that you see on the chart here. And the Fed did this to try to decelerate the economy, cool off inflation. And so, this leads us to where we are right now and for the past 11 months. So currently the Fed funds rate is in a range of 525 to 550. And the question on most investors' minds is, how long are these rates going to stay in this higher range before the Fed starts to cut to normalize monetary policy? So let's move to the next slide. So the big question, how long will rates stay at the peak? So with this slide, we're highlighting the path of the Fed funds rate in previous cycle. So how do today's interest rates compare to the past? And the peak of this graph, which is indexed at 0 at the top center, shows you this is the average of how long the Fed has kept rates unchanged once they reach the peak. So the average here is about 8 months. We're looking back at these different cycles, which runs about 35, 36 years. Now, the yellow line represents the present. So you can see we are 11 months into the peak of this current cycle. And it is important to remember that each interest rate cycle does have its own unique circumstances, conditions that influence the policy decisions. You have different Federal Reserve chairs, different members, et cetera. So you might remember the last interest rate hiking campaign was back in 2015. And that was really an attempt to, what they call return to normalcy. That was after the global finance crisis. So the Fed back then, along with Chairwoman Janet Yellen, were frankly just trying to get the Fed funds rate off of 0, where it had been for 7 years, which we can all remember those days. And it took 37 months to reach that terminal peak Fed funds rate, and only peaked at 2.25, 250. So thinking about this, it's only taken us 15 months to get to where we are now and to a higher range. And the goal was really to raise rates faster to fight inflation. So what is this telling us? Well, it's telling us what's happened in the past, and it just reminds us that the timing of when rates will come down really depends on the Fed's view of whether they are on track to meet their mandate. So let's move on to the next slide. So where does the market think rates are headed? So the market view of the direction of rates since the beginning of the year has really changed a lot. So looking at this slide, earlier in the year, the market was pricing in 6 to 7 cuts as indicated by the blue line. So you see that on the far left of the graph, you can see those 6 to 7 cuts. Then if you look at the green line, that shows the Fed expectation, and that was for 3 cuts. So what's happened? Well, their minds have changed. So, why? Well, Matt talked about, some of the important economic data. So better than expected, sticky inflation has also, really impacted that decision. So right now, the Fed view is that there's going to be, we think the Fed's view is that there's going to be, based on all the indices or the information that they're sharing, is that there's going to be 1 cut. Whereas the market, is somewhere around 1.5 cuts and what they're pricing in. If you look at something called the Fed funds futures market right now. So market expectation is the first cut will happen at the September meeting. So they met in June, which we'll talk about in a minute. They meet in a couple weeks at the end of July. They don't meet in August. And so currently the market is pricing in a 70% probability of a cut at that meeting. So the bottom line is the first cut is going to happen much later than anyone expected. If we kind of think about, the 6 to 7 versus now, possibly 1. And we also have the upcoming presidential election. And while the Fed isn't political, their action will, likely be viewed politically by either party, depending on what direction they go. So time will tell. So let's move on to the next slide, Matt. So I mentioned the June meeting. So looking at the language, which is always important, for us at PFM Asset Management to look at the language from the Fed meeting to see what Fed meetings to see what the Fed is thinking. So at the June meeting, the committee maintained restrictive monetary policy and kept the federal funds rate unchanged. And again, they're very focused on the data and paying close attention to all the things that Matt talked about, including, of course, inflation. And I think in talking with our trading desk about kind of the market and rates, the kind of takeaway that they view from that language is that the Fed is really in this kind of trust but verify approach. So they're seeing some slowdown in inflation data, but they really want some more months of seeing that. So some consistent downtrends to satisfy their view that they've reached this price stability before they start to cut. Let's take a look at the next slide. So this is one of our favorites. We refer to it as what's called the dot plot. So the latest dot plot shows one rate cut in 2024. So this is kind of in line with what I was just talking about. So if you aren't familiar with the dot plot, this is something that comes out every 3 months. And it's meant to give you an idea of each FOMC member's projections of where they think short-term interest rates will be in the future. So each dot represents a member. So if you take a look at this, back in December, the dot plot had a median projection of 75 basis points in cuts this year. In March, that was largely repeated in their projections. And so the expectation was that rates would fall 75 basis points by the end of the year. Since then, both the Fed and the market expect this to be slower. So the Fed has changed its projection to 1 cut this year, as we talked about. And as you can see on this dot plot, the further you look out, the opinions do change a bit, as you can see in 2025, 2026. So just it's an interesting chart. Now I will note the dot plot has rarely been an accurate indicator of what actually happens to interest rates. But again, we and other financial institutions use it as a way to understand what the Fed is thinking and their view of where they think rates are headed based on the knowledge they have right now of the economy. So turning to the next slide, we'll take a look at some of the Fed's updated June projections. We haven't gotten the July ones yet. So on a quarterly basis, the Fed shares with the market their outlook on major economic data points. And Matt alluded to this earlier regarding the GDP. So let's start with the changes in real GDP, gross domestic product, which is used as an indicator of the general health of the economy. So it's predicted to have relatively consistent growth, which is a lot more optimistic than a year ago. June of last year only penciled in 1% growth for 2023. The Fed thinks we could have stronger growth in the last few quarters of the year to reach a 2.1 projection. Moving to the right, to the unemployment rate, the Fed has made very little change in their job market projections, forecasting future unemployment to be around 4%, so not a lot of concern there. And then the bottom left, PCE, which is an inflation metric Matt talked about, slightly increased projections. The average target is 2%, which is why they haven't, cut rates quite yet. And then the far right is the federal funds rate projection, which we talked about. And looking at these numbers, looks like 100 basis points lower to 4.1% by 2025. So again, this is something that comes out, every three months. So we're going to next wrap it up in just a couple minutes. We're going to look at bond market dynamics. Matt, if we could move to slide 21. So look, liquid investment yields tend to follow short-term interest rates. So what is this chart telling us? So the current monetary policy has meant higher short-term yields for longer than anticipated, which has translated to higher yields on money market funds, local government investment pools like Pliget, for those of you who are in Pennsylvania. And the yield of local government investment pools very closely tracks short-term interest rates, which is denoted by the Fed funds rate in dark blue. The yellow line on this chart represents the Standard & Poor's Local Government Investment Policy Index, and this comprises AAA and AA LGIPs that have stable NAVs from around the country, so not just Pennsylvania and Pliget. These are highly rated portfolios with a WAM or weighted average maturity of 60 days. So securities are rapidly turning over and investing in the current interest rate environment. So these instruments are really closely tied to the Fed, so you can see that trend of tracking really right on top of it. If we move to the next slide 22, so what's going on the longer end of the curve? On the longer end, you can see yields have been quite volatile this year. On the far left, you can see that the 2-year tumbled at the end of 2023 because basically the market overshot those expectations for rate cuts. This caused the 2-year Treasury to fall. Now fast forward to today, and it's back up to almost 4.5 today. Now the 10-year Treasury shown on the right has been a bit less sensitive. It's very sensitive to what the expectations are for longer term inflation. And one of the takeaways from this chart and from the meeting statement is there is some speculation that the Fed may need to adjust their average inflation target higher because it could be slightly out of reach. So a lot of moving pieces here. Let's take a look at the inversion. Thanks, Matt. So taking a look at this yield curve, the money market yield curve, most of the Treasury yield curve has been inverted for a few years now. So what does that mean? It means that shorter bond maturities have higher yields than bonds with longer maturities. So kind of counterintuitive to what we all think. The thought is the further out you go out the yield curve, the higher the rate, a little bit more risk that you take on. So, due to investor expectations for rates to fall eventually. The money market yield curve on the left side represents the shorter portion of the curve up to 12 months, and then you can see that inversion inside of a year. So it's all connected, right? Now the credit curve on the right shows credit spreads between 1 month and 12 months, and one of the things this is telling us is there's just not a significant amount of additional yield for credit instruments. We have seen wider spreads in past years. There's still some spread in credit and value, but that's going to be found in that 8 to 12 month range. So our very last slide, if we turn to it, is the Treasury yield curve, which I think we covered what's happening at the short end and the longer end of the curve, the inversion, and certainly the market and Fed expectations for interest rates the remainder of the year. So kind of to summarize this section, we will continue, everyone will continue to monitor, the Fed meetings, the Fed meeting statements, certainly economic indicators that come out. Matt talked about, the impact, the geopolitical impact, so a lot of factors are at play. All indication right now is the market and the Fed do believe that the Fed is going to cut once this year. And, we'll see, will they cut in September before the election, or will they wait until after? None of us have a crystal ball, but, it will certainly be interesting to see. So that concludes our presentation. We really appreciate the opportunity to be with you today. And Matt and I will be happy to answer any questions. Thank you.